If oil goes to $150, silver does not simply become more bullish. That is the shallow version. The deeper version is this. At a certain energy price, the market can stop behaving like a normal market. It becomes a stress test. And in that kind of stress, silver miners may not rush to sell. Some may slow sales, delay contracts, hold back material, or wait for a price structure that actually makes sense. That is when the story stops being about a metal and starts becoming about the system behind it. This is not just another weekend commodity scare. The setup is real. Global debt has already climbed to a record $348 trillion. The IMF's world public debt measure is around 96. 8% of global GDP, and the fund says it could move above 100% by 2029. At the same time, the silver market is expected to post its sixth straight annual deficit in 2026. And silver supply is unusually rigid because most of it is not mined from primary silver mines at all. It comes as a byproduct of copper, lead, zinc, and gold production, which means higher silver prices do not automatically create a fast supply response. That matters a lot more than most people realize. Now add oil to that equation, not as a headline, as the master input. Oil is buried inside the cost of almost everything that has to be extracted, processed, transported, refined, and delivered. It moves haul trucks, it powers mining fleets, it sits inside explosives, steel, shipping, smelting, and diesel-heavy logistics. So when oil rises, it does not stay in the energy sector. It spreads through the entire commodity chain. And if it rises fast enough, it changes behavior before it changes balance sheets. That is the part most people miss. Markets do not break when the first chart goes vertical. They break when the incentives underneath the market change. If a producer starts thinking, selling today may be the dumbest move I can make, then availability becomes more important than quoted price. That is how a market can still look liquid on a screen while becoming tight in the real world. And this is why silver is so explosive in that environment. Silver lives in two worlds at once. It is a precious metal, which means it reacts to fear, currency distrust, and monetary stress. But it is also an industrial metal, which means it is deeply tied to solar, electronics, grids, vehicles, defense, and advanced manufacturing. So when monetary stress and industrial demand collide, silver is pulled from both ends. Now imagine that collision happening during an oil shock. As of March 2nd, 2026, Brent crude surged into the low 80s after conflict around the Strait of Hormuz disrupted shipping, with Reuters reporting that more than 200 vessels were anchored near the choke point and analysts warning that a prolonged outage could push prices toward or above $100. The IEA had been projecting stronger 2026 output under more normal conditions, but that is exactly the point. Normal forecasts stop mattering when a physical choke point turns abnormal. So the real question is not, will silver go up if oil goes up? Of course it might. The real question is, what happens if oil rises high enough to make yesterday's production economics feel obsolete? Because miners do not live inside theory. They live inside cost, timing, and risk. If oil makes a violent move, 5 things can happen at once. Diesel costs jump. Transport costs jump. Refining and smelting counterparties reprice risk. Currencies get unstable. And the producer starts looking at the silver price and thinking, this does not reflect replacement cost, financing stress, shipping uncertainty, or scarcity risk. At that point, halting sales does not have to mean shutting down the mine. It can mean delaying spot sales. It can mean holding concentrate. It can mean renegotiating offtake. It can mean reducing forward exposure. It can mean waiting for a market reset instead of accepting a stale price. In other words, supply may not disappear, but willingness to release supply can change very fast. That distinction is everything, because once you understand that, you stop watching price first. You start watching behavior. History gives us the pattern, not because Rome, Weimar, and the 1970s are identical to today. They are not. But because all stressed systems reveal the same sequence. First, the system looks solid. Trust is high. Money works. Trade works. The base inputs feel stable. People assume the structure can absorb shocks. Then the system expands. Debt grows. Claims multiply. Leverage deepens. Confidence remains strong enough that people stop worrying about limits. Then comes the break in control. Usually it arrives through war, energy, supply disruption, or a monetary fracture. Suddenly, the gap between paper value and physical value starts widening. Then comes repricing. Hard assets move, producers change behavior, liquidity retreats, and everyone discovers that the real economy was never as flexible as the financial economy pretended. That is the pattern. Rome is a good example, but not for the cartoon reason people use. Rome did not fall because one emperor made one foolish choice. Rome stretched obligations beyond a stable monetary base. Military costs rose. Fiscal pressure grew. The silver content of coinage was repeatedly reduced. At first, the system preserved appearances. The coin still looked official. But the substance underneath changed. Eventually confidence broke, inflation spread, trade fractured, and the state learned the hard lesson every mature system eventually learns. Believable money matters more than declared money. Weimar Germany makes the point even harder. Germany did not just print too much money in a vacuum. It faced war damage, external obligations, political pressure, and a collapse between claims and productive reality. When the Ruhr was occupied in 1923, Berlin tried to bridge a real production problem with financial issuance. That worked only until nobody wanted to hold the currency any longer. Then, behavior changed. People ran to goods, foreign currency, inventory, and anything tangible. The official economy kept speaking one language. The real economy started speaking another. That divide matters right now, because commodity stress always begins there. What sellers are willing to release versus what buyers believe a posted price entitles them to receive. Then there is the 1970s in the United States. This is probably the cleanest modern example. Bretton Woods looked stable until it wasn't. The dollar's gold anchor could not absorb expanding claims forever. In 1971, convertibility was suspended. 2 years later, the oil shock arrived, and the real economy exposed the weakness of the monetary regime. That is the lesson people still underestimate. Monetary flexibility often increases right when physical constraints get tighter. Governments can create liquidity, but they cannot print barrels. Central banks can manage expectations, but they cannot reopen a blocked shipping lane. And when energy is repriced after a long phase of debt expansion, hard assets do not just rally. They start acting like a referendum on the unit itself. That is why this matters now. Because today we are again living in a world built on a quiet assumption that the financial layer can always stretch farther than the physical layer. Maybe for a while, but not forever. The world spent decades building a system around cheap energy, deep financialization, low rates, just-in-time logistics, and the belief that central banks could smooth almost any shock. Then, debt exploded. Public borrowing accelerated, supply chains became leaner and more fragile, commodity markets became more financialized, and silver kept drifting deeper into structural deficits. That is not a collapse call. It is a fragility call. And fragility matters because stressed systems do not respond in a straight line. Let's make this simple. If oil went to $150, would every silver miner instantly stop selling? No, but that is not the right threshold. The right threshold is this. Would enough producers, traders, refiners, and counterparties start changing behavior at the same time to make the paper price look less reliable than physical access? That is the real danger zone. And silver is especially vulnerable there because higher prices alone do not solve the shortage. If silver were mainly produced from primary silver mines, then a higher price might trigger a clearer supply response. But that is not how this market works. Most silver comes as a secondary output from operations designed around other metals. A copper mine does not suddenly become a silver mine because silver is screaming higher. A lead zinc operation cannot magically bypass energy inflation. A smelter cannot invent spare capacity in the middle of a freight shock. So the supply response is slower, messier, and more indirect than many investors assume. This is how shortages become self-reinforcing. Buyers see higher prices and assume the market is fixing itself. But producers see higher costs, higher volatility, and higher optionality value. So instead of releasing more material quickly, they may become more selective. And when that happens during an already tight market, the shortage becomes the reason price keeps moving. We already saw early versions of this in the silver market. Reuters reported sharp spikes in London lease rates during 2285, and the Silver Institute described a liquidity squeeze with lease rates at unprecedented highs. Lease rates matter because they measure the cost of borrowing physical metal. When they surge, the message is not emotional. It is mechanical. Someone needs real metal now, and someone else is not eager to lend it cheaply. That is a warning light. It tells you the market is starting to separate metal from promise. And once that separation begins, oil becomes a multiplier. Not because oil and silver are the same thing, but because energy shock spreads hidden scarcity through every layer of the commodity chain. The mine feels it, the transporter feels it, the refiner feels it, the insurer feels it, the bank financing inventories feels it, and eventually the buyer feels it too. That is when people discover the difference between exposure and access. Exposure is what your account statement says. Access is whether someone will actually deliver the thing when stress hits. Those are not always the same. This is also where debt turns a commodity story into a system story. In a low-debt world, an oil spike is painful. In a debt-saturated world, an oil spike is destabilizing. It hits inflation when policymakers want calm. It hits bond markets when governments need financing. It hits consumers when wages are already lagging. It hits central banks when they want room to ease. And it hits commodity producers when cost structures become harder to trust. That is why hard assets suddenly stop looking like just another trade in these moments. They begin to look like a vote against the stability of the broader model. And this is where many people get trapped by the phrase, "This time is different." They say modern supply chains are more adaptive. They say advanced finance can absorb shocks. They say technology will optimize around bottlenecks. But software does not move ore without fuel. AI does not replace diesel. A faster information system does not remove a physical choke point. In fact, greater complexity often makes systems more brittle, not less, because everything depends on tighter timing and thinner buffers. So what should you watch if this scenario begins to unfold? Not TV commentary first. Watch lease rates, watch treatment and refining charges, watch shipping insurance, watch delivery delays, watch inventory flows, watch producer language on conference calls, watch whether companies start talking more about optionality than volume. Watch whether buyers begin paying up for immediate delivery. Watch whether the paper market says ample liquidity, while the physical market says not at this price. Those are the tells. By the time the mainstream story becomes obvious, the market structure has usually already changed. And if crude ever did push toward $150, do not expect a polite, linear reaction. Expect nonlinearity. Some mines would continue operating. Some would sell less aggressively. Some traders would scramble for immediate material. Some paper holders would discover that a claim is not the same as possession. Policymakers would likely call it temporary. Analysts would debate whether demand destruction will save the system. And all the while, the deeper question would be getting answered in real time. Who still wants to part with physical supply before the new cost structure is understood? That is the entire game. So no, the real takeaway is not oil up, silver up. It is this. When energy shocks a debt-heavy system and silver is already tight, the market stops being a chart and starts becoming a chain reaction. Energy hits cost. Cost hits supply behavior. Supply behavior hits availability. Availability hits confidence. And confidence, once shaken, does not reprice gently. That is when yesterday's assumptions begin dying in public. That is when old quotes become historical artifacts. That is when the visible market keeps offering a number. But the hidden market starts asking a different question entirely. Can you actually get the metal? That is the moment people realize the problem was never just price. It was structure. It was dependency. It was the old belief that paper claims could always move faster than physical limits. For a long time, that belief feels true. Until the system hits the input it cannot negotiate with, and that input is energy. So if this pattern is starting to click, then you already know this video was never just about oil, and it was never just about silver. It is about what happens when a leveraged financial system collides with physical reality. It is about how confidence expands, how debt hides fragility, how a shock exposes the hidden dependency, and how the truth finally arrives through repricing, not because markets become irrational, but because they become honest. And that is the part that catches most people off guard. The machine whispers first, through lease rates, through freight stress, through producer hesitation, through delivery delays, through the widening gap between quoted liquidity and real availability. Then, only later, it screams. If you understand that early, you stop chasing headlines and start studying incentives. You stop asking only what the chart says. You start asking what the producer is likely to do next. And in a stressed market, that question matters more. Because the winners in these moments are usually not the loudest people or the fastest traders. They are the people who recognize when the surface story no longer matches the structure underneath it. And if oil ever does make a real run toward $150, that structure may become impossible to ignore, not in theory, in behavior, in contracts, in supply, in delivery, in trust. That is when silver stops being just another metal. That is when it starts acting like a signal. And once the signal is clear, the market may move faster than most people think.